Good morning. Good morning. It's October 9th. In the studio this morning. It's cold as hell outside. High of 60 today here in Chicago. And it's DJ Stocks with my Born of Osiris hat on. And recycled coffee today. Recycled coffee. Oh, welcome to the show. Welcome to the show. Let me bring the music down. There we go. See how that works? Press a button and the music goes off. Oh, man. So today I wanted to talk about, as you're accumulating money, what your financial advisor, you really don't, they'll advise you on things, except for the one thing they won't do is give you stock picks. And that's what I'm doing here at this channel. I'm giving you stock picks, which even if you have an account at Fidelity, Schwab, E-Trade, Robinhood, they're not going to give you stock ideas or tips. No, they're not. They're not. They want to be paid moolah before they'll even do that. And that gets expensive. In order to get stock advice and tips from your broker or your stock analyst, you're going to have to pay them 1.5% to 2% a year of your holdings. Yeah, and even then, it doesn't guarantee that they're a fiduciary, which means that they're acting in your best interest. Sometimes they'll just tell you to purchase or suggest an ETF or a mutual fund from one of their fund families, or a fund family that's going to give them a bigger kickback than anyone else. That's how it works if they're not a fiduciary to you. So before you hire a financial analyst, you need to make sure what you're getting for your money and whether or not they're a fiduciary and acting in your best interest. And then even after you pay them, they're not gonna actively trade your funds, except for maybe if you're lucky, once a quarter they'll adjust things. They'll send your portfolio through one of their robo advisors. That's like a new thing now, where these companies have programs where they can go through and analyze your portfolio, and based on your risk and your tolerance and your goals, your financial goals that you've set up, they'll suggest or tweak your account, as it grows and gets out of whack. They'll say, oh, you need to sell some of this, buy some of that, and maybe think about buying into this other thing, which we're suggesting this month. Yeah. So that's how that works. And you give them 1.5% to 2% of your money on a yearly basis for that. And it can be good. I did that for several years after the great fight. Excuse me. After the great financial crisis in 2009, 2010, I signed up for that, and I got a deal. Actually, I got a deal because they were working on a new prototype, new process. And they allowed us to sign up for a couple of years at 0.5%, which was a discount and a deal, and it worked out for us. And when I say it worked out for us, it helped turbocharge our accounts. It gave us some stability. It gave us some discipline, we had a process where before we were just kind of throwing money against the wall. So it helped establish some discipline to our portfolio, which really helped our portfolio come back. That was after the great financial downfall, which I've talked about immensely here, and how we got crushed. We got crushed, and the great financial crisis crushed us, and but it all worked out. It all worked out, Uncle Larry. The key thing about that that time was we used it as a time to educate ourselves. We were very hands-on with our portfolio during those years, much as we are now. I mean, we're still very hands-on, but we watched how they did things and what they did, and took note so we could do it ourselves. We didn't have to continuously pay, someone with our good money to make us money. And one of the things that we did, I mean, all these companies, they have stock tools. They got tools that you can use to track all your funds against, your goals, and based on your risk tolerance and all these good stuff, which is great. Like I said, it adds discipline to your investing. But here's basically all you really need. I've got Yahoo Finance. On a daily basis, I just have all these, have an iPad and got all these tickers that I watch on a daily basis, and all the markets up here. So I'll watch for things to change and go up and go down if I see an opportunity. And then the other part that I like when I look at a stock on Yahoo, this is probably the best, most important thing here, is the insights or analysis. When I look at a stock, I make sure that it's either hold by or strong by rated by the analysts, as opposed to underperform. If it's got a lot of underperform and sell, that tells you that stock's got problems when there's a lot of underperform or sell recommendations. So that's probably the best part about Yahoo Finance that I like. Overall, Charles Schwab probably has the best. They have a rating system there too. They have a whole research and analysis part on their website that I like. Now, I deal with Charles Schwab and Fidelity. Overall, I like to say that Charles Schwab's website's a little easier to use and more easy to get at your information, where Fidelity's a little clunky, as I have found in the last year. I've been at Fidelity for about a year now, and it's okay, but the rating system at Fidelity, I really haven't figured it out. It's not as efficient and straightforward as Charles Schwab. They basically, you can drill down into a stock or a mutual fund. It'll give you a whole written analysis, page, 2 pages, detailed analysis of a stock, and it's pretty extensive. So that's what I like. I use it quite a bit. But once you get all your stocks out there and you're monitoring them, that's when you can buy, sell, manage your portfolio, and as I said, buy and hold's dead, guys. Buy and hold's dead. If you're gonna do some day trading, which is what a hedge fund does, let's talk about that. In order for me to get the returns that I'm getting right now, I would need to enroll in a hedge fund. And a lot of these hedge funds, they want 2% of your money on a yearly basis, plus 20% of your profits. Yes, 20% of your profits they want. And And they will do what I'm doing here, buying and selling on a daily basis, trying to squeeze out returns, trying to squeeze out cash for you on your portfolio, and making you lots of money. And some of them will even require you to invest, a certain amount of money for a certain amount of time, like years. 2-3 years you have to sign up for sometimes. So that's a hedge fund, and that's big bucks. That's big bucks. Add it up. 2% of your portfolio plus 20% of your profits. So that can add up to some big money, and that's how that works. So just giving you guys, I'm not going to talk about deals and trades today. I'm probably not going to make many trades today. It looks like it's going to be a quiet day. It looks like the market is up today. It looks like, maybe, let's see, it's 7:30 here. Dow's down 8 points. It's fluctuating back and forth. Silver retracted just a little bit. Gold's down almost $11. So the metals are coming back to earth a little bit, but they're still high. Still high. Silver 48.72 for silver. It's crazy. So that's all I have for Wednesday, guys. DJ Stocks over and out.